I think it's important for us to start talking about where we are right now. If we look at real GDP since the first quarter of 2023, we see that the U.S. economy has expanded at a very healthy pace with some strong quarters above 3%, which is a huge quarter for economic growth, and just one quarter below the 2% level. This is an extraordinary period of 6 quarters of above average long-term economic growth. So if you go back to 2016 and look at this, you can see this economic expansion we've had has been long-lasting. In fact, if you go back to 2011, the average annual rate of growth in real GDP since 2011, after the Great Recession when the real estate industry collapsed, has been about 2.1, 2.2% on average. That's an extraordinarily long period of expansion. Now, as you can see, there's only one period, 2020, which we had a negative real GDP number. That was, of course, the pandemic. We closed down the economy. It's kind of interesting. The second quarter was down 39%, and the third quarter was up 37%. So you had this huge volatility, but the net of all that volatility was only a 1% decline in real GDP over that time frame. So it really reflects a remarkably strong rebound in the U.S. economy. Typically, most economists would tell you that a business cycle, on average, over time, lasts anywhere from 3 to 5 years, any sector of the business cycle. So if it's an expansion phase, it normally lasts about 3 to 5 years. And here we've gone well over 14 years with that one exception of economic growth in this country. It's an extraordinary period of time. And that sounds great, doesn't it? But it reminded me of something that happened to me when I started my business career back in 19 years. Thank you, I appreciate that. I was just started out in banking, and I had an appointment for a 9 o'clock in the morning appointment with a prospective customer of the bank. I didn't want to be early, didn't want to be late, I wanted to be right on time. Of course, the car I drove, it was a clock. There was a clock in the car, and for those of you who are old enough to remember that, those clocks lasted about 2 blocks from the dealership when you bought the car. They were analogs, and then it stopped running. They're not the digital clocks that we have today. I looked around, there was no clocks on any of the buildings around. I had no idea if I was early or late for the 9 o'clock appointment. Well, I was kind of in a quandary, and there was only one person walking down the street. And this person was carrying 2 big, heavy suitcases. I mean, he could barely lift these. This guy could barely lift these suitcases, dragging them along the street. I didn't want to bother him, but I want to know what time it was. So I said, "Excuse me, sir, can you tell me the time?" He says, "Sure." Clunk, drops the suitcases. Pulls back the sleeve on the shirt. It's got a funny looking watch. He hits a button on the side of the watch. The face flies open, and a voice says, "It's 68 degrees outside. The Dow Jones is 927. Tells you how long ago this was. It's 8:55 in the morning. And with that, the face closed up. Now you got to remember, this is the 1970s. There was no such thing as the smartwatches that we have today. So I said to him, "That's the neatest watch I've ever seen. Where can I get one?" He said, "Well, you can. I invented it and I made it. It's the only watch like it in the world." I said, "I tell you what, would you sell it? Because I'd be interested in buying it." He said, "I don't know." I said, "I tell you what, I'll give you $1,000 for the watch." Well, $1,000 back then was a lot of money. He said, "Boy, $1,000, I got to take it." So I wrote a check for $1,000, gave it to him. He took the watch off, gave it to me. I put it on my wrist, started to walk away, and he said, "Wait a minute, don't you want the batteries?" Now, the reason, I must have told that story too many times. You all knew the end of it. The reason I tell that story is, or maybe it wasn't that funny. The reason I tell that story is, with all the good news, you have to kind of investigate the baggage that comes with the good news. The glitz is nice to look at and focus on, but the reality is you've got to look a little bit past the good news. So let's look at a couple of those. Now, the first thing we've got to do is remind ourselves, what is GDP? Have you all seen the Progressive insurance ad on television where the little kid says, what's the economy? And nobody can answer what is the economy? So he's going to look it up on the internet. He'll find out. The U.S. economy is made up. It's a measure of activity in the United States for certain periods of time. It's measured in dollar terms, and it's three primary sectors of the economy. First of all, consumer spending. How much do consumers spend in any period of time? Secondly, capital spending. How much do companies spend on equipment or expansion or facilities? Thirdly, government spending. What does the government spend in each time period? So they add up those three spending categories and then adjust the spending for inflation. So they're trying to remove price increases from the equation. So they're trying to measure the unit volume of activity in the economy for a certain period of time. Now they also look at change in inventories. If a company builds product that's not sold, it's an inventory, that's an economic activity, but it's not included in the spending categories because it hasn't been purchased. And then from that, they deduct the net trade deficit, how much of our spending demand was met with imported goods versus what we exported, to arrive at a dollar level of real GDP, which is inflation adjusted. $23.2 trillion was our total real GDP in the second quarter this year. We'll get the advance report for the third quarter next week. So we'll find out what the third quarter looks like. I'm going to talk about that in just a minute. Now, nominal GDP does not take out inflation. So if you look at nominal GDP, the number is about $28 trillion. So it's considerably above the real GDP number. Now, the reason I went through that is because I have to fill 40 minutes up here, so I had to figure out what. It's a tough crowd. No, I wanted to remind ourselves what we're talking about when we talk about economic growth. We're talking about basically the spending. Now, as you can see, nearly 70% of our total economy is represented by consumer spending. It's what consumers' demand reflects. So the real question about whether we're in a recession or not in a recession or in expansion is almost entirely dependent upon consumers, consumer confidence, consumer spending levels, and the growth of that spending. So whether or not we end up in a recession and an end of this extraordinarily long period of economic growth is largely dependent upon consumer spending, okay? So what I did is I went back and looked at the growth of that category. The yellow is real GDP back to 2016, and the red is personal consumption expenditures, which is that 70% of total real GDP. And as you can see, for the most part, there's a very strong correlation between the increases in personal consumption expenditures and what we end up with as real GDP. A couple of exceptions, of course, to that rule, which I'll talk about in a minute. But for the most part, the economy is dependent upon consumers' willingness to expand final demand and their spending, okay? Now, I then went back and looked at government spending on the same basis. And as you can see, there's three particular quarters or time periods, not quarters, years, in which government spending grew faster than real GDP. First of all, 2019, this is a fourth quarter to fourth quarter calculation. You can see in 2020, government spending grew by 1.3%. The economy declined by 1%. And in the last six quarters, you can see government spending again has grown faster than our overall economy. Now, government spending only represents about 17% of total real GDP. So it takes a significant growth in government spending to have a positive impact on our total economic growth timeframe. Now, we all know why this has happened. Certainly the growth in 2020 was all related to stimulus programs, checks that were sent out, PPP programs, you name it, EIDL loans, small business. I mean, there was a wealth, just a plethora of fiscal stimulus programs trying to get us out of the pandemic. In 2019, we were in the throes of an election period coming up, much like we are right now, and government spending skyrocketed at that point. In fact, it was a huge increase in government spending in front of the elections of 2020. The last 2023 and 24, however, reflect the continued decisions that the federal government has made about fiscal stimulus. While the Federal Reserve has been highly restrictive by raising interest rates from near zero in 2022 to 5.5% for the Fed funds rate by late 2023, over an 18-month time frame, the Fed raised rates in an effort to cool an economy because inflation had skyrocketed. The government, on the other hand, continued to spend money, continued to pass infrastructure bills, probably the biggest misnomer of all time. The Inflation Reduction Act was passed. The government has continued to pass fiscal programs that result in significant growth in government spending. And that has added to the growth in the personal consumption expenditures. So much of this economic expansion, particularly over the last 2 years, has been a function of what I would call modest growth in consumer spending, but the added kicker of government spending coming in, creating what is above average or above trend line total economic growth. It's important for us to remember that. So if we look at some of the segments of the economy, non-farm payroll growth since a year ago continues to be positive. You have to be very careful with this number. This is a monthly number that gets huge revisions the next month afterwards. So for example, the big surprise in early October was the September non-farm payroll growth of 254,000 new jobs for the month of September. That number is going to get revised downward because you had all kinds of funny numbers coming into that calculation. But on balance, jobs have continued to grow, even as many people are forecasting, or have been forecasting, a slowdown in the U.S. economy that has not unfolded. So all the economic forecasts that said we're headed for a recession have turned out to be absolutely wrong over the last 2 years. As you can see, the unemployment rate has ticked up, largely because of the number of new entrants to the labor force. The jobs have grown, but they haven't grown as fast as the number of people who now say they're looking for work. Now, when I say it's ticked up, it got as low as 3.5% back in July of 2023, got as high as 4.3% in the chart. It's down to 4.1%. The old rule of thumb used to be anything less than 5% unemployment rate represented full employment in this country. If you were at less than 5% unemployment, then that was full employment. 5% of the workforce was always in transit. They were between jobs, left one job, moving to another job, temporarily left work for whatever reason, and then would come back at a later time. So 5% unemployment was always considered full employment. And we've run well below that over the last several years coming out of the pandemic. So any measure of the labor force would say, or the labor markets, would say we have a strong and tight labor market. And we still do. I still see signs as I drive around, many places we're hiring, looking for work. There are still many companies and entities that are having trouble filling jobs. So we still have a very tight labor market. As a result of that growth that we've seen, what happened to inflation? Well, you can see that if you measure the PCE chain price index or the core PCE index, and I use that because this is the primary measure that the Federal Reserve uses for inflation. When the Federal Reserve says we have a target of 2% inflation, they're talking about the core PCE price index. And as you can see, that index skyrocketed beginning in late 2000 into 2021 and 22 to the point where the core rate got as high as about 5.5% inflation rate. The total number got up to 9%. Actually, the CPI got up to 9%. But the PCE price index topped out at just under 7%. Huge increase in inflation. As a result of that, the Federal Reserve said we need to tighten things up. So inflation since then has obviously come down. And I measure both here, the core prices as well as the CPI, and there's where you can see the 9% CPI number back in 2022. Both of those measures, both the core PCE price index and the CPI, have come down to just around 2.5% on a trailing 12-month basis. So we have made huge progress on inflation. And the way we did it, of course, was the Federal Reserve raised interest rates. This is the Fed funds rate, which is the controlling mechanism the Fed uses for to control market interest rates. Going from near zero back in 2022 to 5.5%, has stayed there for quite a while until middle September 18th. They dropped that rate by 50 basis points. So we're actually down to a 5% peak in terms of the Fed's guidance. So the Fed has begun to ease monetary policy. Why have they done that? One, inflation has gotten close to their 2% number, and they feel confident that it will get to their 2% number over time. And it was recognized that the 5.5% rate was restrictive monetary policy. And the Fed's concern was continuing restrictive monetary policy would result eventually in causing the economy to turn over and drop into recession. And the Fed did not want to see that happen. So they began the process of dropping interest rates. The net result is this Fed, as you can see, the 2-year Treasury, or the red line, which has a very strong correlation to the Fed's monetary policy position, also turned down with the 50 basis. Actually, the 2-year yield began to drop in anticipation of the Fed cutting interest rates. So you can see here in the last couple of months, a pretty significant drop in the yield on the 2-year Treasury. So market interest rates have come down in anticipation of the Fed cutting interest rates. The Fed puts out guidance each time they have an FOMC meeting. Their current guidance says we will continue to ease monetary policy at a controlled pace going forward, which is to say we're not done lowering interest rates. It's going to continue to happen. And the market certainly has anticipated that. Now, what's interesting, I love to put these charts up with lots of lines on it. What's interesting is that the immediate reaction to the 50 basis point cut in September was to see the yield curve drop dramatically. And that is the September 24th line, the gray line. And you can see that right after that move on the 18th of September, by the 24th, you had the 2-year Treasury down to 3.49 in yield. So less than 3.5%. Since then, the red line, which was done last, the yellow line actually was done last week, you can see those rates have come back up. So the market went overboard. It went way too far in its expectations of Fed cutting interest rates. So the yield on the 2-year jumped up to 3.95, and it was 3.99 yesterday. So we've seen a 50 basis point rise in the 2-year yield from its bottom. As important as that is the 10-year, which dropped to 3.74 after the Fed cut, and is now actually this was done last week. It says 4.03. The yield today is 4.16, so it's up another 13 basis points since this chart was put together last week. Obviously, the market is beginning to believe that the Fed will not cut rates as fast as they had been expecting, or by as much. and that inflation may in fact pick back up again. There may be some risks out there that inflation will go up and not continue to go down the way it has over the last year and a half. So there's a lot of uncertainty in the bond market as to what the Fed will do and when they'll do it and by how much. And that's why you see this much volatility in interest rates over that time frame, okay? So we end up with this huge increase in interest rates. The bottom line is interest rates as of the end of 2023, actually 2021, before the Fed began to raise rates, and you can see where rates have moved since then, okay? So we've had the huge increase in interest rates, but the expectation the Fed's going to cut interest rates more and it will come down. Now, we get to the baggage. This is something nobody talks about in this election. I mean, haven't heard any candidate talk anything about this, and that's the size of our federal debt. This is the total dollar outstanding federal debt as it stands. It has moved from $7 billion, or $7 trillion, excuse me. Forget how many zeros are there after that decimal. At any rate, $7 trillion in 2004, up to over $36 trillion as we stand here today. And you can see that a huge increase occurred from 2019 forward. That's when we've gone from 22 trillion up to the 36 trillion. Huge increase in the federal debt. The government, we already talked about, increased spending. They adopted all these fiscal stimulus programs without an increase in revenues, and they went out and borrowed money. And they borrowed money by issuing US Treasuries. The Federal Reserve did something called quantitative easing, which is part of their process of trying to come out of the pandemic. They went out and took their balance sheet from about $3 trillion of US Treasuries to $9 trillion. So a lot of the debt that was issued to pay for all these fiscal stimulus programs was bought by the Federal Reserve. Now, how did the Federal Reserve pay for it? They have the ability to write a check and when it's presented for payment, they say, yep, that's good. And nobody says anything. So they just write checks and buy treasuries, okay? So part of the process that the Fed's going under right now is a reversal of those quantitative easings. They're letting that $9 trillion mature and run off and not be replaced. What does that mean? That means there's less demand for the treasuries that are now being issued to replace the bonds that are maturing by current holders of those bonds. Obviously, with less demand, but the supply growing, the price of those bonds have got to decline. In order to get people to buy them, you take the price down and the yield up. That's what's happening. So you've got this upward pressure in market rates from the fundamentals, while the Fed is trying to ease monetary policy and stimulate continued economic growth. Now, it's one thing to look at just the dollar level of debt, but the real measure here is, what does that debt represent as a percent of our total economy? We went over 100% of our total economy in federal debt back in 13, 14, right around there. And it has only gotten bigger as we've gone on. You may know when the last time the US government had federal debt in excess of the size of their economy. I'm sorry? World War II. You got it. 1945 was the last time. Here's where you go back to it. You can see the spike in World War II. What happened in the 1950s? We paid down that debt. The economy grew, tax revenues went up, and it was used to pay down the debt. And we let the debt get back down to 25, 30% by 1970. And since then, you can see how much the debt as a percent of our total economy has grown. Nominal real GDP of about $28, $29 trillion is well below the $36 trillion of total debt outstanding. This is the problem. Because at some point, this is going to drown us. The interest and of course the cost of that debt went up dramatically when interest rates went up. So today, The second largest line item in the federal government's budget is interest payments on the debt. It's only behind Social Security in terms of allocation of revenues. It's above defense spending, and it's only going to get bigger because we still have 1% treasuries maturing that have to be replaced with 3 or 4% costing treasuries. So this debt carry, interest cost carry, is only going to get bigger. Ultimately, that chokes the economy off, and that's the issue. And yet, nobody is willing to talk about what we can do to fix this. Now, we have three choices. We can raise taxes to try to pay down debt. We can cut spending, try to pay down debt, or some combination of the two. It's pretty simple. Those are the only three choices we have. Ultimately, this debt level is going to choke us and choke off the ability of the U.S. economy to grow. And we have to address it at some point. But at this point, politically, nobody's willing to do that, have that discussion. So debt is going to continue to be a problem. Having said all that, and by the way, the economists always put up a bunch of graphs. Most of this presentation has been to try to establish that I know what I'm talking about, as opposed to having any real value to you, because the real issue is what's going to happen going forward. And I will tell you the record of economists forecasting the future is abysmal over the last 2 years. Fully 50-60% of the forecasts I see have been calling for a recession for the last 2 years. One has not unfolded. And it doesn't look like it's about to unfold, given the strength in the labor markets and the continued growth in consumer spending. You look at consumer confidence levels, you look at retail sales from September, we're up a whopping 9.9% for the month, which is a huge number when you exclude the autos. If you exclude autos, retail sales were up almost a full 1% in September. That's 12% annualized, which you can't do, but that kind of translates into that annual number. So there's no indication that we're about heading into a recession. With a strong labor market, jobs growing, unemployment low, average earnings continuing to rise, and the level of confidence that exists out there, it takes the consumer to stop spending in order to get a recession. So having said that, here's our forecast. And it's already been, I already have to revise it. I've got third quarter number that comes out next week, up 2.4%. It's probably going to be 3% or better, given the strength in the retail sales numbers that came out last week. So we're looking at another probably 3% real GDP growth number for the third quarter. Now, I do have a slowdown in the fourth and first quarter of this year, fourth quarter of this year, first quarter of next, down to a little bit less than 2%, before it recovers in the second, third, and fourth quarter of next year, when it grows as much as 2.5% in the third quarter. The bottom line is, the forecast is still the U.S. economy is going to grow at about 2 to 2.1% on a fourth quarter over fourth quarter basis going forward. Now that's what I think is going to happen. Now, in order for that to happen, some assumptions have to work out. First of all, the Fed will continue to ease monetary policy. They'll cut interest rates. There's some question as to how fast they will do that and how much they will go at any one point in time. So there's a risk to this assumption that my expectation is they cut rates 25 basis points at every FOMC meeting through the third quarter of next year. If they do that, they will get the Fed funds rate down to about 3 to 3.25%, which I think is a neutral level for monetary policy. Okay? But if they don't, if they leave interest rates higher, economic growth will be slower. The wars don't restrict the flow of trade. If we were to see the Mideast blow up and you can't ship oil through the Red Sea, oil prices will skyrocket, inflation will skyrocket, and the Fed will not cut interest rates. The economy will slow dramatically. So we're assuming there is some result of the conflict over there that doesn't result in shutting off the flow of foreign oil into this country, okay? This is an important one. This is a question I get all the time. I'm assuming there's no clear mandate that comes out of the election. In other words, one side or the other doesn't win the election by a huge amount, by a huge margin. That Congress continues to be divided, with the House and Senate probably 50-50 or maybe slightly tilted one way or the other, but essentially a Congress that can't get anything done that has any meaning anyway. So the ability to start addressing the federal debt and the how do we reduce it and get out of this bind of it being so much more than our total economy isn't going to get resolved with no clear mandate. Now clearly if one side or the other wins the election by a large margin, there will be a mandate. And that mandate will be used. As George Bush once said, I've got the political capital because I won the election by a lot. Therefore, I'm going to use that, spend that political capital to get past the proposals I've made, one way or the other. If that mandate comes out, then it will change this equation. Both sides, at least from a presidential standpoint, are proposing things that will only increase the federal debt. Nobody is talking about anything that is going to reduce the federal debt. One candidate says, I'm going to raise taxes on the rich, and I'm going to spend it. Now, you gotta watch this, it's political. One of the dumbest proposals I've heard is let's give first-time home buyers $25,000 for a down payment on a house. The problem in the housing industry is we're short inventory. We don't have enough houses out there for sale. So let's just create more potential buyers for things that aren't for sale. And Congress has tried for years, but they've not been able to repeal the law of supply and demand. If the demand goes up and the supply doesn't change, the price is going to rise. So you're going to end up with inflation. I mean, that's just one pretty simple common sense approach. If on the other side, we cut taxes and don't reduce spending somewhere, then you're going to see the debt continue to rise because revenues are going to slow. So debt continues to be a burden that gets bigger and bigger. And that's my concern. So I think the best that from an economic standpoint we can hope for is no clear mandate, that we come out with a very close election, that nobody has excess political capital to spend on getting their proposals adopted. I mean, that's what I'm assuming here. If one of them does win by a large margin, then I've got to reassess the expectations for economic growth in 2025. Finally, unemployment rate stays below 5%, that there's sufficient number of people looking for jobs and companies that are trying to fill those positions that we see the unemployment rate staying below 5%. This is critical because consumer spending will grow as long as jobs are growing, as long as incomes are rising. The solution to the problem we have right now of people not feeling good about the economy because prices had risen so much, prices haven't come down, they've just stopped growing as fast as they were. Now the solution to that is time. What has to happen is incomes have to rise over time without an increase in inflation in order for people's incomes to get back to a point where they can afford the prices of what things are today. Unfortunately, in this environment, in this world, the last thing we have in this country and by the electorate is patience. Nobody wants to wait for that to unfold over probably several years to get back to compensating for the higher prices with the growth in incomes. So it's important that the unemployment rate stays below 5% in order to make sure that those incomes rise and that we finally allow this to catch up. And that's what I mean by real disposable income growth has to be positive. Real disposable income takes out the impact of inflation. And it says, after inflation, what has my income done? It has grown. It's slowed in its rate of growth in the last 3 quarters, but it is growing. So incomes are rising faster than the inflation rate, largely because the inflation rate has come down as much as it has, and income growth has continued. Critical assumption on my part as to whether or not we get through next year anywhere near what I'm forecasting. So that's my forecast, and those are the assumptions that are critical to that expectation that this long economic growth period we've had, this expansion that's now 15 years long, excluding the pandemic year, is about to end. There are a lot of forecasts out there that say it is about to end, that we're going to see a recession in 2025. A lot of business people right now that I hear from tell me that they are reluctant to borrow money right now, do a project, buy new equipment, expand their factories, all of that, because they're not certain what consumer spending is going to do, what the fiscal policy is going to be, what the election results are going to be, what the wars are going to end up doing to us, and whether or not we avoid a recession. So a lot of companies are sitting back waiting for time to pass. Companies generally can be a lot more patient when their earnings are going up as they have been, even without significant growth in their top line revenues, because they've been controlling costs. So we're in a period right now where there's a great deal of uncertainty. The outlook for 2026 or 7 is really difficult. It's really cloudy out there as to how long this economic expansion can continue at this pace. And I think there is justification for a lot of business people to sit back and say, I need to wait. I need to see something more before I make that decision. Sounds a lot like the Federal Reserve, who says we need more data before we make any decision on interest rates. So we're sitting in a period of uncertainty, but given the assumptions that I've got in this forecast, if those assumptions turn out to be correct, then we get through 2025 with something above long-term trendline growth of 2 to 2.2% real GDP, be slightly higher than that. Inflation will remain above 2%, won't get down to 2%. Unemployment stays below 5, jobs continue to grow, and incomes continue to rise. That will allow consumer confidence to be sufficient to generate increasing levels of consumer spending. That avoids a recession. Thank you all for listening, and I appreciate your interest. Thank you.